Okay, perfect. Hi, everyone, and welcome to the Marketplace Risk Virtual Event Series. My name's Andrea, and I'm the Director of Events and Logistics here at Marketplace Risk. Today, we welcome Mateos Riolfi, co-founder and CEO of Tint. Our virtual events are designed to help marketplace and sharing economy startups successfully navigate complex risk management, trust and safety, compliance, and legal subject matter, so they can avoid distractions in order to focus on launching and growing. Be sure to check out marketplacerisk.com to access hundreds of hours of content, including our master's program, platform podcast, and previous live events, and to subscribe to our newsletter where we keep you up to date on everything, including the Marketplace Risk Management Conference in San Francisco and the Sharing Economy Global Summit in London. If you're interested in speaking at one of our events, please submit your ideas. The Marketplace Risk Management Conference call for speakers is now closed, but if you're interested in presenting or sponsoring, please email us at info@marketplacerisk.com. And finally, the Sharing Economy Global Summit call for speakers closes on August 15th. Thank you for tuning into today's session, How Marketplaces Self-Insure to Improve Conversion. First, a couple housekeeping items. This webinar is being recorded, so the recording will be available for you to access on the Marketplace Risk website. Second, all attendees have listening capabilities only and are otherwise muted. And third, do submit your questions via the control panel. If we have time at the end, we will answer your questions. If we don't get to yours, please feel free to email us at info@marketplacerisk.com and we'll get your questions answered. And now, without further ado, Mateos, over to you.
Thank you, Andrea, and thank you everybody for connecting in the morning and the afternoon, depending where you are. It's going to be a very interesting hour to talk about insurance, which is a topic we all love. So first, thank you for that. And in the end, I'm planning to leave at least like 15 minutes for questions in the end. So please send them. But to Andrew's point, we can get back to them if we don't have time. All right, so let's get started. First, a little bit about me. I'm a Brazilian, as you can probably tell by the accent if you know other Brazilians. I moved to the US more than 10 years ago to come to business school. And I got into insurance by accident, probably like most of you, when I joined Turo and back in 2014 when the company was still a very small startup. And I joined to lead the international expansion. And little did I know that 80% of my time would be spent with insurance. And I sourced insurance policies in Canada, in Europe, and I was working in the US as well. And that where I also met Jerome, my co-founder at Tint, and the Turo experience, kind of going through this journey, trying to set up an insurance program within a marketplace, kind of really enlightened us of the kind of huge opportunity that was ahead of us, and kind of inspired us to get started with Tint. And then at Tint, what we do is we help marketplaces to create their own embedded insurance programs and make that in a very easy way. So we're gonna cover a lot about what exactly that means later. So the agenda for today, like we're gonna cover basically two topics. First one is what is risk and self or insurance or self-insurance for marketplaces, and then the second part is like how do you create your own self-insurance program. So obviously the first is just to show provide an overview of what it mean exactly, and the second one is I'll go in a more detailed way of how that can be done. So let's start with the first one. So in the kind of most fundamental levels, and obviously you guys know all of this, like the marketplace is trying to create a very liquid connection between supply and demand that is better than those kind of parties getting together without a marketplace. So what it means is like marketplaces have to work with matching, payments, trust and safe, protection, like really putting a lot of layers that can help the company create value and keep some of the fees or charge fees, or keep some of the value that is created in this connection between supply and demand. So long are the days where you could just do some kind of Craigslist-like approach and just take care of matching and don't have to think about anything else. And in a way, that's kind of how the insurance discussion comes to marketplace, right? Insurance, it can be, if done well, can be one of the biggest tools that a marketplace can have in its arsenal to create trust, which is one of the main components what get people coming back to the marketplace versus kind of doing things in kind of the gray market or off platform. And but obviously, like the marketplace, by accepting or by getting involved in some of those risks, has a very important strategic decision, which is how do I manage risk and growth? Obviously, if you create a marketplace where anything is allowed, you're going to have a lot of growth because you're going to convert 100% of transactions in the short term, at least. But obviously, you're going to have a lot of risk, and then over time, that's going to erode the trust, erode the quality of the marketplace. So the kind of the overall result won't be great. But if you have too many friction and we don't take any risks, obviously you don't have a single transaction. So then that kind of balance, it's a very hard one, but it's one that I'm sure you're familiar with, and it's very critical because this is the beginning of the journey of you thinking about how much you want to get involved, how much protection you're going to offer to your users, and how would that integrate with your core business. And the reality is like bad things will happen. Like that is certain, right? Like if you accept some level of risk, statistically speaking, with enough transactions, with enough rentals, bad things will happen. And that's why insurance and like thinking about those things, it's so important, because marketplaces will be defined by how they do how they react when those things happen. And you see as examples here, like Airbnb with many kind of party and damage scandals. Uber obviously has its fair share. And again, I'm bringing those examples not to pick on the companies, because again, that happens to all of you, and that's why you're here. And when you think about the risks that you're probably considering, like you have fraud that typically falls into trust and safety. There's like property damage, which is every time somebody is using some sort of asset, especially in the sharing economy, that is a potential for the asset to be damaged, like if a car, a boat, or an RV. There's a risk of chargebacks and bad debt, so customers that owe you money but won't actually pay. That is the risk of incidental, so people having bad behaviors, people cursing other members of the community, smoking in cars and things like that. And there's always a risk of a liability of the action of one member of the marketplace will cause damage, sometimes even bodily injury to third parties, and that can create legal liabilities. So when you think about the insurance and how do you think about those risks, like you should consider all the risks that you face holistically, and we're gonna get back to that later. So what can you do actually, right? Like when to handle those problems. So one option is just to say it's not my problem, right? And again, there is a Craigslist approach to this day, which is like, I don't care. I'm just giving people the tools, and then I'm not liable for anything that happen. Obviously, this is not the best approach, and I mean, we personally considered that that marketplace shouldn't do that, because then the value you create is much smaller. So the other alternative is to protect your users, create ways, think through ways that whenever those bad things happen, they are protected financially and physically even. And then when you think about the financial side of it, you have two choices. You can retain all the risk, or you can transfer that to a third party, an insurance company. We're gonna go through those points as well. So historically, all those risks were transferred to insurers, right? And that's kind of how the insurance industry was designed 400 years ago, and it still operates pretty much the same way. That there is a risk, you want to get rid of it, so you purchase an insurance policy, and then the insurance company will aggregate the risks of a lot of different people and companies that manage them. And that logic works very well for all the risks. They are homogeneous across different companies, across different people, because then the insurance company can get all the insights and see beyond what any of the individual players see. So for example, if you want to insure your headquarters, I know you are coming out of a remote kind of period, but assuming most companies will go back to the office and have headquarters. So there is a risk that this headquarters is going to catch fire, but that is a risk that makes a lot of sense to kind of transfer to insurance company, because they kind of looking at fires and they can aggregate all those risks. So there is no competitive advantage for, say, Airbnb in insuring their corporate building against fire versus any other insurer that can actually looking at thousands of, and if not millions of other buildings. But this has changed for all the risks. They are related to the marketplace's business. They're inherent to its core business. But why is that? Because in the cases where this risk is related to, is intrinsic to the business. So in the case of Airbnb, let's say somebody trashing an apartment, or like some guests like having like a party and breaking things, or those risks, like they are better understood. Like Airbnb has a lot of data about the customers and the usage of the platform to understand why those risks happen, when is more likely to happen than an insurance company, because Airbnb has access to a lot more information than the insurance company. And what is as important, like Airbnb has access to those customers, right? Access to the end users. So they have the perfect, let's call it storefront, which is like in the Airbnb experience, to like offer or embed that insurance protection to the customer. So like it doesn't require this person to just download an app for an insurer and kind of go purchase a separate protection. So those two components, they are something that create a moat. They are competitive advantage for marketplaces. Like the more you grow, the more data you have, the more customers you have, the stronger the position to understand the risks. And we saw that at Turo, right? At Turo, like probably nobody in the world, and there are no company in the world understand Turo's risks, like PHP or car sharing risks that come from the Turo platform, than Turo itself. And that, one of the main reasons why Turo eventually self-insured most of its risk. But we still need a third block, which is like having the technology, the infrastructure, the compliance, everything else to power that self-insurance program. This is less of a competitive advantage, or it's probably not a competitive advantage at all, because really the core here, the key insights will lie on the data plus access to Insure. So while the tech and the insurance backend are important, they can easily be outsourced, because that's not how one company would differentiate from the other. But then when we apply this logic of like, okay, something has changed, some of these risks make sense to be self-insured, some can still be transferred. Like if you go back to fraud, incidentals, the property damage, the bad debt, all those risks should be self-insured, because those are the ones that the companies have a lot of data and a lot of kind of potential to predict those risks, therefore price and insure. But the risks like liability, they are less a good fit for self-insurance, because liability typically involve very large losses. They are very rare. So the marketplace probably doesn't have enough data. Even a relatively large marketplace hopefully has not seen many liability claims, especially very large liability claims in its history. So that is a good example when it still makes sense to probably transfer that risk to an insurance company that is actually seeing liability claims across the entire industry or many industries. And there's strategies like high deductibles that you can take some more self-insurance retentions where you can take a bit more of this risk, and we're going to cover that. But you still working with the insurance partner to get that. And this is what changes everything. This idea that the marketplaces or platforms or companies more broadly are generating many insights around their risks that they can not only distribute but also create new insurance products. It's, in our view, it's what the most exciting part of embedded insurance, because if you think about this history of the industry, the insurance products are still the same structure as they were 400 years ago. Even when they came online in the 2000s, they just exactly the same product with a different channel. Embedded insurance changed everything, right? Because now who designs the products, who underwrites, who keeps most of the kind of product operations and the profits is no longer an insurance company, or at least not alone. So that really changes the entire industry. And it's a very large industry, so that trend will have like very important impacts in the next few years. And if things worked as planned, fast forward 10 years, marketplaces, vertical SaaS platforms, now companies that are not seen by traditionally as insurance companies will provide the protection that their customers need without the need of a kind of standalone insurance product. And one of the main reasons why marketplaces would consider doing this is because they can keep all the profit, right? Again, as I mentioned, in a world where they get the data, they can get you the losses and kind of quantify and predict their losses well themselves, that probably doesn't make sense for them to pay over 50% of the premium to insure, right? They can keep pretty much everything. So suppose you now spend $1 million a year in insurance for your marketplace to cover basically what your users are doing. Well, if you can't predict that and keep most of this in-house, you're gonna make an additional $500,000, right? That's one way of thinking about it. Obviously, there's gonna be some work that is required from you, which is the work that Insure is doing today, and we'll get to that. But it still can be very significant, and in some cases it's just going to boost your profitability, but in most cases it can even change your unit economics. Maybe you don't have to charge as much for your service fee because now you can kind of bake some of kind of additional insurance profits to it. So again, that will vary case by case, but we've seen that typically after a certain scale, this can be very profitable. And that is as I mentioned, like some kind of cons that come with it as well, right? So obviously the pros, and I'd say the biggest pro is full control over your destiny, over your insurance product. Because a better insurance product that's really tailor-made to your users, to what they need, that can really accelerate your conversion. Because basically what you're doing here is that you're taking some risks that are in your customer minds that are preventing them from buying more, and you are making them go away with a protection, right? So again, going back to Turo, my former employer, if I'm a host and I'm gonna rent a car to a stranger and I'm not protected, like that person can just never come back and my car is gone, I will never work with this marketplace, right? I will never do this transaction. And same for the renter. If the renter is one of the cool things about Turo is that there are a lot of nice cars. So if the renter is renting a Tesla and it's $100,000 liability and there's no protection at all, that you may park to go or somebody, you may hit something and have a big loss and you're kind of out of pocket for that. That like a lot of renters wouldn't do that, wouldn't use Turo. So that is a good example of how insurance, and having control and designing it the right way would accelerate the conversion of the marketplace. Profits are, you can't keep the profits as we discussed. Designing it well around self-insurance and kind of with all the proper frameworks, guidelines, captives in place, kind of help with regulatory compliance. It shows that the company is thinking the same solvency and the same precautions that will be expected from, say, an insurance company. You can get access to your insurance. Again, I won't get too technical here, but you can still transfer some piece of the risk, even if you're self-insuring kind of different parts of the risk. And depending on where you are in your cycle, you can have some tax advantages in a sense that typically the taxation of insurers is a bit more advantageous of standard corporation. But again, that doesn't apply to anyone, and you should absolutely check with your tax advisors and tax lawyers to see if that make any sense for you. And then in terms of the cons, I mean, the biggest con is that you are on the hook. So before, if you had a bad year, if you're working in insurance, that is going to be reflected on the insurance side. You can have your costs fixed. But obviously, if you self-insure and then you have a terrible year, and depending on how you structure your product, like that will cost, right? Like your program is going to have a loss, and then it's going to come back to your P&L. So that's definitely a risk and reward decision here. Typically, you need to commit some capital for reserves, and depending on the size of your program, that can be again, depending how profitable it is, it may not be a lot of capital, but typically, you need a minimum of $100,000-$200,000 to kind of set up upfront reserves. That can be financed. You can use letter of credits, but let's say you're gonna have to earmark some money for that, because now you are accepting more risk, and then you should have some ways to pay for that. And there is some setup cost. Typically, captives cost, or self-insurance programs in general, cost between $10,000 to $50,000 to set up and annually to maintain, depending on what exactly you're using, who you're using. But there'll be some costs for you, but obviously you should deduct that from your hopefully profit that you're making on the other side, and then that should be a great ROI, but no, there'll definitely be some setup costs. So because of this, we typically see a journey to self-insurance. So it's very common that marketplaces, when they were small, so if you look at the horizontal axis, we're looking at kind of size of the company, and then on the vertical axis, what percentage of their risk is self-insured. We see that now marketplaces in the early days, seed round, sometimes Series A, when they're kind of having 100K, 200K, 300K kind of GMV, they use insurers, because at that stage, then the setup costs and the risks, they don't have enough capital or buffer to use that. So they use insurance, try to get the lowest deductible possible, which means transferred almost all the risk. And then over time, as they start growing, they started taking a bit more of this risk via having higher deductibles to the insurer. But at some point, when they hit a right critical mass, and then depends on the marketplace, the profitability of the program, but we see as early as $500,000 in GMV, annual GMV, sometimes even less, they do the move to self-insurance. And typically that comes with the physical damage part of the risk. So, case of Airbnbs, people breaking things inside apartments. Case of like car sharing related, it's the physical damage to the vehicle. We see, in case of shipping, is physical damage to the items that being shipped, or in storage, physical damage to the storage. So that's typically the easiest one, because the physical damage is the most predictable. So they are the easiest risk in a sense that they tend to be low limit, so low amount of money on the hook, and they tend to be very predictable. So after a few thousands of transactions and maybe a few hundreds of claims, they start to be very predictable. So it's easy for the marketplace to just kind of price them and know what you expect plus or minus a certain confidence range. And then from there, what we see is that they self-insure pretty much all the physical damage, and at the liability part, they still keep an insure, but they start to get higher and higher deductibles. So what that means, let's say if you insure a loss that can happen in a marketplace up to $1 million in value, you can start with, at this point, maybe $100,000 deductible, which means that any loss below 100,000, it's going to be on you. So it's effectively self-insured. And we see marketplaces increasing that to 200, 300, 500, sometimes even higher as they get more kind of cash and confidence on their business as well. So, I mean, that is a kind of the message here is like it's definitely a journey. There's not right and wrong, but there tends to be a correlation with size of the company. And we've seen that happening everywhere. So if you look in mobility spaces, good travel. I mean, we talk a lot about Turo and Airbnb in this presentation, but like different marketplaces and even other companies that tech companies more broadly, or even like traditional companies like airlines, they all kind of getting involved somehow and can offer insurance or protection more broadly to their customers. And like the biggest ones will do like keep a lot of that as a self-insurance part. Cool. So now moving to, okay, but how do you create your own self-insurance program? That obviously it probably requires a much longer conversation, but the goal here is to give you a little bit of the taste of like what are the kind of things that you need to think about and how to approach it, and what are the options that you have from here. So at least you can get the conversation started with your team if you're interested and if you haven't done that yet. So first, let's address that. It can be intimidating. Like thinking about insurance, and even if you work with an insurer, is already very intimidating. Thinking about self-insurance, probably at first sight may feel even more intimidating. So you have to think about a lot of different things that are going on that can cause confusion, even if you are an experienced risk manager, but especially if you are a tech person that is coming to this for the first time. And that's exactly how I used to feel when I kind of first got started in this insurance journey. So my first, probably 6 months at Turo, were like ramping up, trying to figure out and pretty much learn on the fly, like as we were negotiating with insurers, like trying to figure out what's the deductible, what happened if we increase the deductible, and what's a good price and how much discount we should get if we were to do that. So that can be very overwhelming. But the good news, or one way to start thinking about it and start kind of putting some constraints in place so you can actually kind of reduce that complexity, is that start with your core business, right? Again, one of the main it sounds obvious, but it's often forgotten things about thinking about insurance in the context of a marketplace, is that insurance is here to support your core business, to protect your customers so they can buy more of your core business, they can use more of your marketplace as possible. So start with your core business. Think about what are your growth goals? What are your margin goals? Like do you feel like you want to charge more for insurance and kind of make it or protection, or make it optional? And if yes, is like, are you doing this because you want to increase your margins? But if you just gave the insurance for free or the protection for free to everybody, that could maybe doesn't increase your margin, but does increase conversion. So like, how are you thinking about those trade-offs? Think about the UX, how you want to handle operations, and we're going to go through a bit more detailed questions covering each of those factors. But no, start with your core business. And this is something where a lot of traditional insurers miss the mark because they don't think about your core business, right? They're thinking the opposite. They're thinking, okay, I have this insurance product that I designed and is a standard kind of off the shelf. How can I kind of fit that in somebody's marketplace? So it's really not about what you need, it's about how can they sell what they have. And then I think that's a again simple, but it's a powerful way to think about and help you frame your decisions. And another thing that we've seen is that world-class companies will make the protection part feel very simple and straightforward to the user and convenient, and they'll hide all the complexity behind the scene. So typically, we're seeing that a very common, and there are many ways to design this, and then each like the right choice may depend on your business, may depend on what specific sector you are, how you want to approach the kind of margins discussions. But we've seen that one framework that it's very common and is used by marketplaces is a framework where you kind of provide a simple and easy protection to the customer. So, and we're gonna cover examples later, but let's say in the Turo case, you say, okay, if you rent a car on Turo, you can, if you hit somebody else, no third-party liability, you're covered. And then if you wanna kind of buy protection to cover the physical damage on the car, I'll give you, 3 easy plans to choose from. So from the user perspective, like, okay, liability is included. I have 3 physical damage protection, boom, makes beautifully designed on the checkout, price appropriately. They go through, they book, done. So it's really one-click process for them. Behind the scenes, Turo and other marketplaces like will definitely need to handle. Maybe they have multiple insurers for the same policy. Maybe they're self-insuring most of it through a captive insurer, and this captive insurer, they're gonna have to figure out where is this gonna be domiciled, like what kind of captive I want to do. So there are a lot of other decisions that kind of have to go be considered here. But honestly, the end user doesn't care. The end user just wants appropriate, great protection at a great pricing at the right time. So it's kind of the job of the marketplace to really kind of address and be very good at like the complexity, but hide that from the end users. And that's exactly what Airbnb does, right? So they used to have different programs, but they just kind of rebranded everything under what they call the air cover. So if you see this screenshot is the user facing, and the promise, like, you're getting protected through air cover. And then if you read a little bit below, they say, well, this air cover provides you $1 million damage protection and $1 million liability insurance, and it's always included whenever you host. So this is kind of focusing a lot on the host because they're the ones that kind of own the asset, and kind of I imagine the Airbnb case are more concerned about those kind of damage. So that's it. Like, Airbnb has a team of like, I think hundreds, probably dozens, if not hundreds of people working on different policies from different insurers. A lot of this is self-insured. So if you look on the right side, the damage protection part, as far as I know, it's all, mostly, if not all, self-insured. The liability piece, and I think they work with different insurers, but no, I'm betting they will retain most of the risk on that as well. And then they even went as far as like getting liability insurance for experiences, which I know from their team, which was not trivial, right? Because if you think about the experiences they offer, you can find anything from a dinner in a city, which is easy, to a bouncing bed in a hot air balloon that is actually flying. So that was not a small fit. But again, if you're the user, they've done the work. They have a beautiful design telling you that that's protected, and that's what you care about. And I think Airbnb did a great job there. But then you probably at this point may be asking, okay, if I do that myself, it's great. I get the profits, understand, I have the data, I can somehow mine those data and get the underwriting sites, but who's gonna do the work? Like, again, there will be claims, like how is this gonna work? Who is gonna fix that? Which is what claim management is. So then basically there are two main options that they can coexist depending on types of the claims and etc. But there you can do that in-house. We're seeing that it's very typical for marketplaces to do claims in-house. Because the main reason is like, they want to control the experience. They want to they have easier access to validation and data. So for example, a claim comes through, you need to figure out that that's legit. The marketplace has access to who is the owner, who is the renter, what are all the kind of transactions they had they filed claims in the past. Like, no, it's easier for somebody from the team to figure out this part of the claim. And at least like do a first filtering, even if they work with insurance partners or with TPAs, which we're gonna get in a second. They can still do some sort of like basic filtering. So typically they do get involved somehow, and that normally is a job of the trust and safety team. We've seen sometimes it's customer support, but like a lot of times that kind of falls under the trust and safety umbrella. And depending on the complexity of the marketplace, they even start to create like a standalone claims team that's going to focus on this. And then on the other side, like, it can be outsourced. Typically it's for a TPA or a third-party adjuster. So there are companies out there that all they do is to process claims on behalf of other companies, both insurers or self-insured programs. So they will have they'll be specialized. They will have knowledge that know in a certain type of claim. So say you're a boating marketplace, you want to fix boats. That's a very specific knowledge, and there'll be TPAs there. They're good in fixing boats. So if the company doesn't want to create that that in-house, they can use that. They are typically scalable and they don't have fixed costs, right? So they tend to be more expensive in a per transaction basis, but you don't need none of it. All of this is variable, so that can be a good thing for depending on what you want to do. And they can handle different types of claims, or you can have a combination of different types of TPAs. So it's not uncommon that marketplaces kind of use TPAs for very complex claims on there's say a liability kind of multi-year process, and or for like classic cars or like very kind of specialized inventory, and they handle some of this in-house. Again, there's really not right and wrong here. It depends on what's your strategy and how do you want to handle that. But what is important is it doesn't matter the route you go, you provide a great customer experience, because the insurance product is really as good as the claims experience, because before that it's just a cost for the user. They really interact with you, and they come like a take you on your promise when they file a claim, and see how that is handled. Great. So again, there are a lot of moving pieces here as we talked about, but we kind of created a list, and it's a sample. I think the full list will probably have more, or for sure have more items than that, but just created some questions that you should really ask yourself as you go through this process and kind of align with the team, because as long as you have those questions kind of well answered and agreed, then designing the program is not that hard. So first one is like, what kind of risks do you want to kind of risks are creating friction, right? So again, going back to the example of Airbnb, is like hosts, if they didn't know they were protected, they probably wouldn't list their properties. So that kind of damage to the property and liability to the host are two risks that create massive friction on the Airbnb marketplace. So those are ones that make sense for them to think about. then for those risks, do you have enough data or insights to understand and price them? Sometimes it's a big friction, but like if you have no clue of how many times that's going to happen, how much costs every time it happen, it can be dangerous to self-insure, because in that case, like what if this actually happens all the time, and what if it's very expensive? Then it can have serious impact in your business. What coverage do you want to offer? So do you want to cover just in case like physical damage and liability? Are you okay just doing physical damage, or no, only liability? How much you want to self-insure? Again, it's related to the coverages and the data as well. Can you find partners for the insurance? Because some risks are like, okay, I want to transfer because that's too dangerous. Well, if you think it's too dangerous, an insurer most likely will think that is even more dangerous. So you may not even find a partner to do that. So is it a realistic choice, and how much time and effort you would take? Do you want to include the protection, or do you want to offer that as an add-on? Or do you want to have a hybrid model where like part of the protection comes included and part is sold as an add-on? Again, not right and wrong; those kind of have very different implications to the business. But no, this is very critical, because that kind of simple decision would influence a lot of the licensing requirements, like the communication requirements that you have to do on your side. Where do you want to offer that? And most customers in this space offer this at checkout. After the customer found the property, the kind of the tasker, whatever they want to do, they are, and if this is charged, but like if this is extra, then they kind of typically see that as part of the checkout flow. But that may not be the case. Maybe they want to create a premium tier that always includes insurance, and in that case you offer that at sign up time as opposed to at transaction time. So like there are a few ways that you can do that. Do you want to process claims in-house or use a partner? How about the systems? Like, you need to keep track of who purchased what at what price. Ideally, especially at scale, you're doing risk-based pricing. So you kind of price appropriate to the risk of that transaction. Who is going to build that? Are you going to do that in-house? Are you going to use a partner that can bring the technology to you? And then who's going to manage this? Like, do you want to hire a head of insurance and then build a in-house team to do that? I mentioned Uber and Airbnb, in a certain sense, like Turo, companies that started 10 years ago, they didn't have a choice. They all end up building their teams. How are you going to do the same? Or and even if you build the team, are you going to hire for all the functions, like, or are you going to have specific functions that you keep in house and others that you use partners? Who's going to manage the captive? So I haven't gotten too much details about captive insurer, but it's a mini insurance company that where you kind of take the risk out of your balance sheet, like for kind of compliance, efficiency, and tax perspective as well. And that requires somebody that is probably licensed to just manage that. Like, who is going to do it? Like, you typically kind of find some external party to do that. And the last part, I think it's important to think, is that how do you want to handle kind of catastrophic losses? Like, do you want to reinsure? So, for example, imagine again you are Airbnb, and then you have a lot of properties in Miami, and then suddenly there's a hurricane or a flood, and 1,000 of those properties get damaged at the same time, or something like that. Like, do you want to handle that? Like, how do you want to think about, and how does this interact with the insurance that the owners may have for the same place? But what if the owner is not there and the property is being rented out? Like, so there's definitely some kind of more discussions of like bigger events. If your business have an exposure to that, like, what do you do? Do you self-insure? Do you reinsure? So again, the goal here is like, this is not exhaustive, but it kind of shows you the kind of things that you need to think about. Well, the good news is for you is like there are options, right? There are multiple types of partners that can get you there. It really depends on how much you want to control and how much effort you wanna put that, right? So if you want to have like low control, and then you want to like build most of these things in house and build out the connectivity to insurers, then I think like incumbents and brokers, like they're great because they been on the block for some time, so that they have some domain expertise, but they typically don't have any or very little or any kind of technology kind of integrations, and so they require you to build pretty much everything on your side. So it's definitely a high effort proposition. Then the digital players, obviously they come with this kind of technology edge, so they will make your integration efforts and engineering requirements much lower than the incumbents. And I think the way we differentiate there is like, well, then it depends on your control. Like there are digital insurers, digital brokers, now companies like Extend, Clyde, they just provide one line of business of insurance, or Next Insurance, that is like one line of business or a few lines of business available through API. You can just plug and play and start using, but that obviously gives you very little control and very little customization. It's just you're using that products on your platform. And then if you want a full customization and control and self-insurance and all those things that we talked about, it like you want to create your own insurance solution, then I think players like Tint, we call it an Insure in a box, will be a great solution, because those companies, what they do is they provide you the infrastructure that allows you to then to build on top. So think almost like the operating system that you and your team are building on top, but is still you're still in full control. You still own 100% of the P&L, the risks, and you have all the possible configurations. And if they do a good job, that they take care of most of the checklist to you, or they can simplify that in a few choices that you can make and control, but you don't have to deal with captives and decide if the best domicile is Oklahoma versus North Carolina. Like they should take care of all of that for you. So closing thoughts here, invest time to think about how you own your destiny and your profits. I think that it's, as I mentioned, like doing the insurance product well, and especially if you self-insure it, you get like a very healthy marketplace, and you get a lot more profits. So think about that early. Maybe you don't need to act as early. Maybe you start with Insure to get the first insights, as I mentioned in the journey. But no, start thinking about that, because that did a very well for Uber and Airbnb and Turos of the world, but like it definitely can do the same for your company. Like that would unlock your growth, and that would really kind of create a competitive moat versus kind of other companies in the space. And finally, ask for help if you need. We all tech companies, we're all proud about our kind of tech skills, and we believe, and probably right, that we can build anything. But ask yourself if you should spend time and resources building kind of insurance infrastructure and other things that are really not part of your core business, versus putting your resources more on search, in kind of trust and safety, and other areas where you can kind of differentiate more. So that's it. Well, thank you so much for your time. I hope that was useful, and we can now open for questions.
Awesome, thank you so much. So we had a few questions come in, and again, if anyone has any other submissions, please put them in the panel. Our first question for you, can you explain a little bit more about Tint? So just a little more background information on your company.
Yeah, well, For sure. So I think we provide, like, we have the insurance insure in a box solution, right? So we have all the software that the companies will need to kind of operate the insurance program, and we have APIs that plug directly into the products for things like creating quotes for customers, like knowing what price you charge from home, keep track of everything, the claims management part, so the teams can adjust claims, pay claims, kind of all in the same place. So creates kind of, again, so the marketplace just plugs an API, doesn't have to think about any of the systems. And then the other part that we provide, that we call the insurance backend. So we are both a licensed broker and a licensed captive manager. So we can set up the infrastructure of the program, finding an insurer or kind of setting a captive for the self-insurance piece, and kind of working with the company to make sure that it's all compliant. We have our own legal team that kind of reviews and helps with language and contracts and everything. So again, from the marketplace perspective, it's a kind of end-to-end solution that you still get to keep the control, you still keep the profitability, but now you operate everything on our platform as opposed to building everything yourself.
From our next question that came in, are there certain marketplaces that are better fitted for self-insuring over others?
That's a good question. I think that the ones that have physical damage component are definitely better fit, because again, without getting too technical on the insurance lingo, like the best items for self-insurance have typically lower like size and limits and kind of amount of money that can be lost, and they are short term, so they kind of happen and they get solved quickly. So say I rent a car for the weekend, I hit it, and then it costs $5,000 to solve. Somebody pays $5,000, gets fixed in a week, problem solved. Versus, let's say, if there's a liability claim, then I'll maybe be lingering, there'll be lawsuits, and may take 5 years to get to resolution. So the short-term ones are better, and they tend to be related. Damage is one. So like every marketplace is renting stuff, and their stuff can be damaged is a good one. We've seen that the kind of secure deposits rent secure deposits for kind of lending marketplaces that can be a good one as well. So any kind of financial risk that can be done some like as a self-insurance as well. But no, we've seen many different use cases at Tint, so I definitely recommend you check with us. We'd be more than happy to kind of give you a free kind of assessment of the viability, and if in doubt.
Great. Our next question that came in, from your experience, do marketplaces, specifically small to medium ones, embed the self-insurance in the transaction price or sell it as an add-on?
So this is a hard one because I've seen 50-50. We definitely think a lot about this. We're seeing 50-50. We're seeing companies in the same industry doing differently. I think there's not right and wrong. Personally, I think that charging as an add-on, it's a better choice, because in a way, if you charge, because there's no free lunch, right? If you're adding in every single transaction, everybody's paying for it. So it's probably better to just, and different people have different preferences, risk tolerances, and even within paying, maybe they want to pay a more premium one that's more expensive but has even less risk. It would depend. So because people have different preferences, I think giving them preferences and making it cheaper for the people that kind of either they don't need or they don't want or something tends to work better. And then it's almost like if you give it for free, and then it's very hard to take it away. So Airbnb, for example, I mean, I don't know if it's an urban legend, but from what I hear, they kind of created the insurance for free for everybody, from like reacting to a crisis, which was the first time an apartment was trashed, and that was all over the news and things like that. and then the week after they decided to provide this kind of guarantee included in all transactions. If you do that, it's very hard to charge. Then if you charge and if you see it doesn't work, well, it's easier to just say, okay, fine, now we give it to everybody. So yeah, that's how I would think about it.
Okay, our next question. In space renting marketplaces, please require COI. How do you handle that if you're self-insured?
I think that is definitely, that requires a bit more deeper understanding of exactly why is that a COI required, what exactly you need to provide. But I think there are ways that self-insurance, if you need a licensed insurer to issue a paper, there are ways to work around, not around, but to provide that as well. So again, I didn't cover as much here, but they're fronting companies that all they do is to write their paper or let you use their paper, but also transfer 100% of the risk to outside them. So they just charge you a fee of the premium to just provide the COI or the licensed insurance. So again, it depends. It can be done, but ideally, the marketplace would achieve the same goals of why somebody's asking a COI in a different way. I think that'll be, I'd say, the most efficient route.
Okay, we have about 2 more minutes. I'll try to get one more in. In your experience, at what size is a marketplace ready to manage insurance in-house versus a TPA?
I think this one is less about size because it's kind of counterintuitive. But the company starts when they are too big, they probably is going to be hard to create that competency in-house. So suppose you never done anything, you're large, you are a Series D plus marketplace, you never done anything, and then suddenly you start a program that has 5,000 claims, right? Because your volume is massive. Like, well, good luck managing 5,000 claims in-house right away, right? So, and that is a scenario where it probably makes sense to go to a TPA. But I was saying, like, this to me feels more like a strategic decision. We've seen companies of same size, same space, deciding different ways. So it's just a matter of like, on the trade-off is typically in-house you control. It's going to be cheaper per transaction, but then you have all the complexity of managing. And then if you outsource, obviously is the opposite. It's more expensive per transaction, but no, it's as a service, so you don't have to worry as much. But then you have less control over the experience as well.
Amazing. Well, I think that's all the time we have for today. Mateus, do you have any final remarks before I close this out?
No, well, final remarks says thanks. Again, think about insurance seriously. That can be like a big competitive advantage if done well. So yeah, well, if you're here, if you're spending 1 hour of your time thinking about that, that's already a great beginning. And yeah, let us know if there's anything we can help.
Okay, perfect. Well, thank you everyone for joining us today. And as a reminder, check out marketplacerisk.com to access this recording, along with hundreds of hours of content, and to subscribe to our newsletter to stay up to date on all events. Thank you everyone and have a great day.
Thanks, bye.